Welcome back to the desk. If you're looking for a clean trend today, you are looking in the wrong market. February 19th, 2026 was a textbook fake-out session. We opened with a massive tailwind from a blockbuster jobs report, with the S&P 500 flirting with all-time highs in the first hour of trade, only to see the entire bid get sold off by noon. By the closing bell, the red ink was dry. The S&P 500 slipped 0.3% to 6,861, and the Nasdaq losing 0.3%, as well as the Dow got punished, dropping over 260 points. We've got a lot to unpack, from Walmart's retail warning to a sudden spike in the fear gauge, so let's get into the tape. The morning started with a good news is bad news paradox. The Labour Department dropped a bombshell with 130,000 jobs added last month, nearly double the 75,000 economists were looking for. On the surface, that's a sign of a bulletproof economy, with energy and materials stocks like ExxonMobil and Smurfit Westrock immediately caught a bid, jumping on the idea of a no-landing scenario. But here's the catch. The street realised that a labour market this tight means the Federal Reserve is going to keep the hawkish thumb on the scale. Hopes for a spring rate cut are evaporating faster than liquidity in a crypto crash. The CME FedWatch tool is now pricing in a 78% chance that Powell holds steady through May. Traders are starting to realise that higher for longer isn't just a meme, but it's the 2026 reality, with yields on the bond market moving higher accordingly, and that eventually sucked the auction out of the growth trade. If the Fed didn't kill the mood, Walmart certainly did. The retail giant issued a cautious outlook for the rest of 2026 that sent a shiver down the spine of the consumer staples sector. When the world's largest retailer tells you they're worried about fading consumer confidence and geopolitical risk, you listen. WMT shares dragged their peers down, leading to a 1.5% drop in the consumer staples SBDR, ticker XLP. We're seeing a divergence here. The labour market is strong, but the consumer's wallet is getting squeezed by cost-push inflation. Meanwhile, in the airline sector, American Airlines, ticker AAL, took a 5.3% haircut as crude oil prices hit 6-month highs. When jet fuel costs spike and your 2026 earnings target is already aggressive, the market doesn't give you much room for error. Now let's talk about the geopolitical X factor. Crude oil isn't just up because of demand, it's up because of heightened US-Iranian uncertainty near the Strait of Hormuz. This pushed WTI crude oil up to $66 per barrel today, giving a rare green day to Exxon and Chevron while the rest of the board bled. Investors are clearly spooked, and we saw a significant rotation into safe havens. Gold edged upward, and the VIX, though down slightly from its intraday peaks, remained on high alert. Even the AI darlings aren't safe. Nvidia pulled back today after its recent run, and software names like Salesforce and ServiceNow are underperforming as AI disruption fears start to outweigh the AI growth hype due to Anthropic's new model. We're seeing a narrow group of leaders holding up the Nasdaq, and that concentration risk is starting to look a lot like 1999. So, where does that leave us for the rest of the week? All eyes are on tomorrow's PCE inflation data. If that comes in hot on the heels of today's jobs report, expect the rate cut narrative to be officially buried for the next half of the year. We're also watching for the Nvidia earnings call on the 25th. That's the real North Star for this market. Until then, the play is defensive. Watch your stops, keep an eye on the dollar, ticker DXY, and don't get caught up chasing those early morning spikes. The market is telling us it's tired. It's worried about the consumer and it's bracing for a geopolitical shock. Manage your risk accordingly, and I'll see you tomorrow's open.